We're diving into the U.S. stock market report for January 4th through the 9th, 2026.
The story of the week was this massive, almost unbelievable contrast. I mean, on one hand, you have the major indices pushing to fresh all-time highs.
Right.
But on the other, the thing driving it wasn't really some booming internal economy. It was this potent mix of a huge geopolitical shock and some data that was, well, definitely softening.
It's fascinating, isn't it? You had these two big forces, geopolitics, and a slowing labor market, kind of battling for control of the narrative all week. So we're going to break it down for you into 4 parts. The overall timeline, the individual stock winners, what happened in commodities and bonds, and then a really detailed upside watch list from the report.
Okay, let's get into that timeline. Looking at the big picture, U.S. stocks did close mostly higher. The S&P 500 was up a pretty respectable 0.9%. But the Dow Jones jumped almost double that, about 1.8% for the week.
And that difference, the Dow moving almost twice the S&P, that's a huge clue right there. The Dow is heavy on industrials, on financials. So its outperformance tells you that the rally early in the week was really led by those non-tech sectors.
Energy and finance specifically.
Exactly, before the big tech and AI momentum kind of took the baton later in the week.
And the real tell for risk appetite was hidden away in the small caps. The Russell 2000, which is often that gauge of speculative mood, it jumped a massive 3.8%.
A huge signal.
Yeah.
And the catalyst for that initial shift was just, well, it's unprecedented. The U.S. raid that captured Venezuela's President Maduro, which all went down between January 4th and 5th. That just shocked the energy sector.
Looking at that immediate reaction on the 5th, I mean, oil and energy stocks just shot up. We saw Chevron jump a full 5%.
5%. And Exxon Mobil was up 2.2. Even the banks got a lift, like JP Morgan up 2.6%. The thinking, according to the report, was that the Trump administration would move fast to, stabilize and help rebuild Venezuela's oil sector.
And then that geopolitical move turned into a very specific policy driver, didn't it?
It did. President Trump later announced this plan to import 30 to 50 million barrels of Venezuelan oil, and this is the critical part, invest the proceeds directly back into U.S. oil majors.
Wait, funneling the money directly back into U.S. companies, doesn't that create a huge risk of, market manipulation claims or some kind of regulatory backlash?
The report definitely acknowledges that risk, but it notes that, for now, investors are just focused on the immediate supply side. The policy basically guarantees a long-term revenue stream for companies like Exxon and Chevron. It just boosted the whole sector, regardless of the political optics.
Right. And meanwhile, all that geopolitical tension had the classic side effect of fueling a flight to safety.
Oh, absolutely. Gold soared about 3%, hitting record highs near $2,000 an ounce. But the real standout was silver, just a dramatic surge, up 8% Monday, another 6% on Tuesday.
Trading your $78 an ounce?
It's an incredible move, because while gold is a pure geopolitical play, silver is also getting this extra kick from industrial demand, for solar panels and even some components for AI infrastructure.
Speaking of AI, the tech sector momentum from late 2025 just seemed to completely ignore all the international drama.
It was like it was operating on another planet. AI-focused chip and tech stocks just kept leading the gains.
We saw Micron Technology jump 10%, and its spin-off, SanDisk, soared an incredible 28% on January 6th alone.
And that relentless demand is what drove the Nasdaq to new highs right alongside the Dow.
But that rally can't go on forever, right? I mean, we saw NVIDIA dip. It's a bellwether, and it fell about 2.6% on the 8th. Was that a sign of fatigue?
The report flagged that mostly as profit-taking after its huge run-up. The general sentiment in tech is still really robust. I mean, we saw news that Alphabet briefly became the second-largest U.S. company this week. That just shows you the sheer scale of big tech's dominance right now.
So if we connect this all back to the broader economy, the data was creating that tension you mentioned at the start. It was really mixed.
Absolutely. The ISM Manufacturing Index for December, it was still in contraction at 47.9. But then ISM Services, which is the bulk of the economy, it jumped up to 54.4.
A classic two-speed economy then. Manufacturing is shrinking, which the Fed probably likes to see for inflation, but the services side shows the consumer is, well, still spending.
And that tension just got dialed up with the labor market data. The JOLTS jobs report for November, it fell to about 7.15 million openings. That's the lowest we've seen since September of 2024.
And the ADP private payrolls report backed that up. It was up only 41,000, way less than expected.
So all this data means everyone's attention is now just laser-focused on Friday's official December jobs report. The expectation is for a pretty muted gain, maybe 60 to 75,000 jobs, with unemployment at 4.5%. Any surprise there will really set the tone for next week.
Okay, last policy point from this section. Defense contractors rallied hard after President Trump floated a huge $1.5 trillion military budget.
But policy is a two-way street. We also saw homebuilders sell off after Trump publicly criticized investor home buying. D.R. Horton fell about 3.6% just on that comment alone.
Wow. Okay, now let's shift gears. We've covered the big macro waves. What about the companies that just moved on their own news? We've got 3 really good examples of these idiosyncratic movers.
First up is Western Digital, ticker WDC. The stock was up around 17% in after hours, trading on January 6th.
And that was a pure, unadulterated AI play, wasn't it? Strong demand for memory storage, robust orders for their NAND and SSDs.
Exactly. And their spinoff brand, SanDisk, which focuses on flash storage, It just soared, up 27.6% for the week. Massive moves, just based on product demand.
Next up, a totally different sector. Constellation Brands, STZ, the beer, wine, and spirits maker.
Right, Corona, Modelo, all those.
Yeah.
They jumped 4 to 5% midweek simply because their quarterly earnings beat expectations.
A stronger profit outlook is one of the most powerful catalysts there is, especially for a consumer staple company in this kind of noisy environment.
And finally, let's look at Ford, ticker F. It climbed 4.7% on January 8th. This one was all about an analyst call.
Piper Sandler upgraded the stock to overweight, and their reasoning was all about improving margins and the EV strategy finally clicking, right?
That's the key. They believe the scale-up of the F-150 Lightning and the Mustang Mach-E plus cost cuts is finally leading to some sustainable stability.
The takeaway here is so important. Even when the market is getting thrown around by these huge geopolitical forces, strong execution or a big analyst upgrade can still deliver these massive individual returns.
And if you're finding these kinds of connections, valuable linking policy, geopolitics, and what it means for specific stocks, please hit that like button, subscribe to the channel, or drop a comment. It really helps us know which deep dives are resonating the most with you.
Okay, so stocks were wild, but let's look outside of equities. What happened with commodities and bonds when investors got nervous? Oil, which started this whole thing, was incredibly volatile.
It was a total roller coaster, driven entirely by the Venezuela headlines. U.S. crude spiked 1.7% right after the raid, but then it fell back about 2% midweek.
After the U.S. signaled they would be increasing Venezuelan exports, that seems counterintuitive.
It does. But by the end of the week, Brent crude was around $61 to $62 a barrel. The bigger picture here is the supply situation. The IEA is projecting a 4% oversupply in 2026, and that's what's keeping a lid on prices, even with all this drama.
Okay, and on to the safe havens. We mentioned gold hitting new highs. But the silver story is really something else. Near $78 an ounce is just incredible, considering it was around $30 a year ago.
It's a massive move. And the question is, can it hold?
Right, it looks like a huge speculative surge.
And the report notes something important here. That spike, which briefly touched $80 an ounce, it actually triggered higher CME margin requirements.
So for our listeners, that means the exchange makes it more expensive for traders to hold those speculative long positions, right?
Exactly. It's a built-in mechanism designed to kind of cool things down if the tension eases.
So finally, bonds. Did all this volatility shake the ultimate safe haven U.S. Treasuries?
Not really. Overall, Treasury yields were little changed. And that stability is the market basically shouting that they believe the Fed is on hold.
The 10-year yield hovered near 4.15%, the 2-year near 3.47%. So the market thinks the Fed is done hiking, even with rates still near 15-year highs.
Precisely. That flattening yield curve is classic for when the market expects a pause. Corporate bond spreads were stable too. Liquidity was normal, despite the chaos everywhere else.
All right, for our final segment, let's get into the companies that the report flagged for high potential upside, starting with Micron Technology, MU.
Micron's a big one, about a $360 billion market cap. They're a leader in memory and storage DRAM and NAND, and crucially, they supply high bandwidth memory, or HBM, for AI data centers. They're one of only 3 major suppliers in the world, along with Samsung and SK Hynix.
You mentioned HBM high bandwidth memory. For people who aren't deep in the chip world, what makes that so critical for AI? Why can't standard memory handle it?
That's a great question. HBM is essentially memory that's stacked vertically, right on the chip itself. It's designed to move insane amounts of data. We're talking gigabytes per second, with extremely low delay. Standard memory just can't keep up with the demands of training and running these huge AI models.
So it's a bottleneck technology.
It's the bottleneck technology, and that explains the optimism. Micron just forecast blowout earnings, and they're raising their 2026 capital spending to $20 billion, all because of AI demand.
Their catalyst looks solid then. Continued AI build-out, memory shortages driving prices up, and new long-term cloud contracts.
And their balance sheet is strong. Bankruptcy risk is very low.
Okay, next up, the oil giant, Exxon Mobil, ticker XOM. About a $500 billion market cap.
And this brings us right back to the start of our conversation. The new U.S. policy promises to channel all that Venezuelan crude right through U.S. refineries, which is a direct benefit to Exxon.
So even though they cut some spending for 2026, they're still positioned to gain from this.
Very much so. Their upside catalysts are all about supply and efficiency. Higher output from Venezuela plus strong refining margins, especially for diesel, would directly boost their earnings.
The report also mentioned industry consolidation as a possibility.
Right. The majors using their cash to buy up weaker rivals. And honestly, even if oil just stays around $60 a barrel, their valuation should rise. With their cash flow and dividends, the risk profile is exceptionally low.
So we wrap up a week where the market was just pulled in 2 different directions. You had the short-term geopolitical shock powering energy and safe havens.
Versus the cooler, longer-term reality of slowing labor data that's whispering caution underneath it all. And so investor attention just immediately pivots to next week's crucial data.
On Monday, we get the CPI data for December. The consensus is for some deceleration there.
Then Tuesday, U.S. retail sales, which is a huge tell for consumer demand. And Fed Chair Powell is speaking at Davos, so everyone will be listening for any hints on policy after these soft labor reports.
We have analyzed this detailed report for you, connecting all the dots across equities, commodities, and bonds.
But, and this is really important, remember that all investing carries risk. We've done the deep dive into the source material, but you must always conduct your own comprehensive research. Do your own research before making any financial decisions.
A week of new record highs, driven by that geopolitical energy shock and persistent AI momentum, all of it tempered by some very mixed data. It really sets the stage for a critical January.